hit record, and then I'll post this to YouTube so that we can go watch it later, and then we can still chat on the Discord if you want, or any of that. So today's a mess. We'll talk about like how to do some evaluation type stuff in just a minute. But so FedEx is tanking. They're down 21% today. They just said that there's like globally there's a lot less shipping and stuff going on than normal. So that is usually a bad sign. Well, it's a bad sign for any company if they're like, hey, our major form of income is going down. But it's FedEx, which is like everyone's major form of income because like everyone ships stuff everywhere. So they're thinking a lot less shipping is happening around the world. So maybe a lot less buying is happening around the world. At the same time, we have an inverted yield curve, which is usually a sign of upcoming recession or just currently in a recession. So the yield curve shows the different interest rates that you get on different lengths of time on debt. So the longer term debt is on the right-hand side here, and the shorter term debt is on the left-hand side here. Typically, it should be upward sloping, right? Where you'd have the short-term debt might have a really low interest rate because you're only in it for a little bit. The long-term debt, if you're willing to commit your money for a long time, banks should be compensating you for that length of time of committing that funding by giving you a higher return, right? So these are yields. It's the yield curve. So short-term debt right here, which is what is this? This is a 1-year federal treasury, and that's just shy of 4%, while the 30-year way out here is 3.5, right? A little over 3.5. So kind of crazy. The green line is today, and the yellow dotted line, it's kind of hard to see with yesterday. But we could compare this to 1 year ago. The green line will still be today, but the yellow dotted line would be 1 year ago. So just completely different, right? So 1 year ago, short-term rates were essentially zero, right? And now short-term rates are 2.5, a little over 2.5. A year ago, longest term rates was at 1.9, and now short-term rates are higher returns than what a 30-year bond was 1 year ago. The what is that, 1 month treasury gets a better return than last year's 30-year bond, right? Just way different. Like, I mean, the Fed's raising rates, so you should expect as rates raise that this whole yellow line should move up to like almost be a clone of the yellow line, just high up where the green one is. But in fact, the short-term rates moved up way faster than the long-term did. And that means people are worried about committing to the long term, right? They want to be in short-term investments because they don't want to be overcommitted. They're worried, if I commit to something more than 1 month from now, who knows what the economy is going to look like, right? So actually, this is where it peaks. So that is the 1 year. So if I commit to something for more than 1 year from now, I start trailing off, thinking, that's probably not a good deal. And this is the 10-year. And they're thinking 10-year debt is probably not a good idea right now. Then it picks up a little bit and goes back down a little bit. This is essentially flat in terms of yields. The 10, 20, and 30 is kind of just flat there. Yeah, absolutely. You can ask questions all the time. Yep. Yeah. So yeah. So okay. So for the benefit of the recording, I'm going to repeat your question because somebody might watch this later. So how does owning a bond change when the interest rates change? Like if you own a bond and you're going to own it for a long time, interest rates change. What does that mean for me? So when you own a bond, it's essentially a contract, and so your bond that you own doesn't change for as long as you own it. So let's say the bond says it's $1,000 bond, kind of traditional for bonds, and they're going to pay you 5%, so that's $50 per pay period, and then at the end it'll be $1,000 and $1,050 actually. They'll pay you that last payment too. They get $1,050 at the very end. So each of those $50 payments is set in stone for as long as you own that bond. So yep. So once you own that bond, you get, let's say it's a 30-year bond, you get $50 payments every year for 30 years. And then the Fed comes along and says, well, we're going to raise interest rates to 12%, and you just got this 5% bond paying $50. Everyone else is going to get paid $120. And so now your bond is not very good, right? Nobody wants that bond. So the price of your bond fell, right? For you to sell, you can always sell your bond, yeah, and get out of it. Say, I'm not going to take the $50. I'm going to go sell this 50. I'm going to go buy a 120. 120s are going to be more expensive because that's better, and 50s are going to be cheaper because nobody wants it. So you're going to sell your bond for cheaper to buy a 120 that's more expensive. So when interest rates go up, bonds that currently exist, their prices will go down. Current bonds that are being sold are generally sold like at par. Oh, that's not true. It depends, but it could be closer to like whatever the current rate is. It's fair value. Because what are you going to do? You don't know what the next rate is going to be. Yeah. Are you raising your hand? Yeah, yeah. This is called a yield curve. And so the whole program I have pulled up, let's minimize all this, is Bloomberg. So Bloomberg Terminal is the thing that we use, this green looking one right here, right? And so when you open that, I logged in. When you first open it, you got to create an account, log in and everything, but I already logged in. And so when you open this, you can use Bloomberg to do a lot of investment research. So one of the things I looked up earlier is I did FDX, it's FedEx company, and I'm looking in the United States, and then I hit this key for equity, which is their stock. And then I want their quote, which the shortcut for that is BQ, Bloomberg quote. And so I hit enter, and I get, after it loads, I get a quote for FedEx and what's going on. So I was showing that they're down 21% today. This is their intraday chart of what's happening. So this was yesterday, and then it crashed and opened this morning here because they announced, I think yesterday after the market closed, they said they announced their earnings, I think, and they said things aren't looking too hot. The stock price tank. Yep, it's down 21%, which is $160. Or no, sorry, it's priced at right now $160 after having fallen whatever amount it fell, 43. So it went down $43. So it went from about 200 down to 160, and it's about 21%. Yeah, that's a mess. So the reason I'm bringing any of this up at all is because we, as the student managed fund, are going to need to look for something to invest in, right? And the market is not looking hot. So we might want to be in something defensive. Here's what the market overall, not this, here's what this is the S&P 500. So this is a map of the S&P 500. And so each box's size represents the size of that company. So you can see Apple, Microsoft, Google, Amazon are the biggest boxes on there. That's because those are the biggest companies. You can see Meta is a little bit smaller than Google and Amazon. J&J is pretty big right in the center. MasterCard and Visa are pretty big, right? But then there's all these small companies, and like these are all really small ones. So whatever Newmont Corporation is, they're pretty small down in the corner there. Nucor Steel Company, they're pretty small. This is Chevron. So think of how gigantic Chevron is, and then look, that's how small their box is, right? It's crazy. But so most of the market not doing too good today. And a few days ago, the whole market tanked really hard when the inflation numbers, everything kind of just picked up a little bit right there. When the inflation numbers came out on Monday, was it? I think it was on, or Tuesday. Yeah, it's Tuesday. And inflation numbers came out. Inflation's higher than normal, so everyone expects the Fed to raise rates. Yeah. Yeah, this is the map of this is only including the stocks on the S&P 500. I can change this, but this is right now including the stocks on the S&P 500 grouped by industry. Yes. Yep. Yeah. So the brighter the green, the better they're doing today. This is only today's change. I can change this to be like over the course of the last year or whatever, but this is just for today right now. So right now, today, Apple is down 1.05%. It's not good for me because I own Apple stock. I'm actually I bought it above 150, so I've taken a loss on it now. The brightest red is the worst, right? So Amazon's down and it's by percentage. So 2.4% down on Amazon is brighter red than Microsoft, which is kind of like almost, they're essentially flat. It's the darker color is pretty close to flat. Coca-Cola, KO right here, they're essentially at zero, unchanged. So they're almost like a black color, right? You can't even tell that that's supposed to be green. And then Lowe's is basically no change. So, but then Home Depot is up pretty good today, so they're pretty green. Over here, I don't know what this is. Dollar Tree. Okay, so Dollar Tree over there is pretty bright. And then down here, gold apparently did pretty good today. So Newmont is probably a gold miner. And so they seem to be doing pretty good. But each like section, so financials, these are all financial companies over here. This is all tech companies up here. Communications, healthcare, more healthcare. This whole area is healthcare. Consumer cyclical, which is like retailer type stuff. Consumer defensive, which is retailer, but the kinds of retailers that people spend more money at when the economy is doing bad. So when you think about right now, people are a little bit worried that we're like our economy is not going to do well in the near term because they expect the Fed to raise interest rates to combat inflation. which means costs of growth is going to increase, right? So companies can finance their operation by borrowing money, or they can sell stock. Stocks are sucking right now, so maybe they'll try to borrow, but the Fed's going to say, we're going to raise interest rates, which means that their loans are not going to be they either have to charge more, or they're going to be charged more. They have to pay more to finance their debt, or if they don't pay more, then no one's going to want their debt, right? That's the idea. So we might want to look at consumer defensive for our portfolio, because what are these? These are the kinds of companies that people buy even when the economy is not hot, right? Hershey, that's kind of funny, but confectionaries, people are still going to spend on junk food, I guess. Beer tends to do better. Agricultural stuff tends to do better because people are going to buy food even if the stock market's crashing. But technology, high tech stuff, communication stuff tends to be not as good. Healthcare tends to be okay because people are going to be forced to pay for healthcare whether they can afford it or not, essentially. So those tend to not be, they tend to weather recessions a little better. But it depends, because you can see like this area of healthcare is fine, but down here, healthcare plans, which is health insurance companies, not doing as good. And that has to do with because they're insurance companies. Insurance companies are more sensitive to interest rates. And then medical devices is bad. I'm not sure why. I don't know the industry of medical devices very well. But biotech seems to be doing okay, right? So we might want to like focus on certain sectors just so that we can say, okay, well, if we think the next 6 months of the market are going to be awful, let's focus on the things that probably are going to do better. Because really our goal as the SMIF is not to make, I mean, it'd be awesome if we just make tons of money, but really what we care about is we want to beat the S&P 500, right? Because in terms of like overall strategy for our fund, if we can beat the S&P 500 over the course of the next year, the university is going to give us a ton more money. That's kind of, you all might graduate by then, sorry, but I have to plan long-term strategy. So I would love for us to say, hey, look, the S&P 500 crashed like 12% over the course of the year, but we were flat. That's fine, right? We don't need to make any money. We just need everything else to fail while we stay still. We win, right? It's like when a bear chases you or whatever. You just have to not be the slowest. That's the idea. So that's, if we can do that, that's good, because then the university can say, okay, well, maybe we can give you like 100,000 or a million would be really cool. So yeah, that's the plan. Okay, so I had talked before. I know there's new people, so it's okay, but I had talked last time about like what kind of things we look at. Did anybody bring ideas to look at? Okay, yeah, which would be one of those defensive ones, right? Is this in right? That's it's Kellogg. I don't know what crafts. Okay, I don't know, man. There it is, KHC. Boom. I double clicked on it. So this is their chart. This is from stock charts, right? I don't know what it is about FinBiz, but our like firewall for the university keeps like trying to shut it down. The legit website. I don't know. Okay, so this is their chart. Why did you want to look? So what are you thinking other than what I just said about them being defensive? Let's pull it up on here instead. Yeah. Okay. Um, CN is what I was looking for. Okay, so if you run CN on the Bloomberg terminal, then it pulls up the company news for that specific company. So I went to Kraft first. So here's how I did it. KHC, which to be Kraft Heinz. I specifically want their U.S. operation type stuff. On these keyboards, I hit F8 for equity. Actually, you could hit F8 on a regular keyboard too. It'll still pull up equity. So I want their stock. And it's CN for company news. And then it pulls up, here's all the news for Kraft. So, okay, brand new pizza. That's perfect. No, that's not really probably gonna matter. We can go like, maybe we restrict the news a little bit to not, okay. So they have a little thing to say, well, I want just the most important news. There we go. And let's see. Shares down, but this was a couple days ago. What were you thinking was going to change with them? Okay. Okay. Perfect. So we might want to look at the financials. So let's do a couple ways we can do this. So I'm going to do FA. How are they? So, I mean, the biggest news right now is that interest rates are going to be increasing, right? We expect that. It might be that the Fed doesn't raise interest rates, and then that'll be a major surprise, right? And so things will change drastically when that happens. Probably the market will go up a ton, like everything will go up. But we could take a stance of what companies are going to do better when interest rates go up, right? And that would be, I don't know, but how exposed is Kraft to interest rate changes? So we might look at what their overall their debt load, right? So if we go look at their balance sheet, actually ratios is even easier to do any math. Yeah, whack. Yeah, they're whack. Yeah. A pie chart. Yep. So the weighted average cost of capital. Yeah. So that's how are they financing the company? So this is for Kraft. So always double check, because if you open up a new tab and try to run it, sometimes it'll like go to the default stock if you weren't within a certain stock when you type it. But so this is Kraft's weighted average cost of capital. So cost of capital is how do they get the money that they have, right? How did they finance their assets essentially? So they have market cap is their equity, short-term debt, long-term debt, and then preferred. The preferred shares are almost like a hybrid of stocks and bonds. And then they don't have any preferred, so we don't care about that. But long-term and short-term debt, they have a lot more long-term debt, but they're mostly market cap, right? So for all of the debt that they have, most of it is financed through long-term, right? But of all of their financing, more of their company is about 2/3, a little more than 2/3 of their company is financed by equity compared to debt. So if they were going to try to, or if they needed to grow in the future, and this is a question where you have to get a whole story together, right? I can't just say, well, this is what's going to happen. Like I got to go look at like all of their plans and everything going on with them. But I can kind of work my way into it. So I say if Kraft was going to expand in the future, then they might have a certain cost where they're using long-term debt right now, and that's okay, but we can go look at their debt structure. I might do that through the 10K before I do it on Bloomberg, but we can try. If it'll pull up. Okay, cool. So this is the different debts that they have and when they come due. So they have, this is specifically for Kraft, and so what is green? Amount unknown, that's weird. They have some amount of unknown debt, I guess, at a 3.9. So their coupon 3.9%. I assume that is. I have to do a little bit digging into all these numbers, but that's why we're here. Is we're going to go investigate that. So in 2027 they have 1.8 million. In 2028 they have 1.5 million. So this is all that comes due. This is all the loans that they have to pay. But then when these come due, they're probably going to have to finance again in the future too, right? So they're going to issue a new debt at a higher interest rate. And this is in terms of amounts, but what can we change this table to break down by coupon? Not type, but like actual. I'd like to see like how much they have at each interest rate, I feel like that didn't change the graph at all. Okay, so here's all of their debts. Some of them are callable. If interest rates were to go down, they could pay off all the debt and then issue a new one. That didn't help though. No, that's just gonna change. It's just gonna get rid of the things. So we might do a little bit of digging into that. So what I might do is if Ricardo, if I was like looking at maybe I want Kraft for the portfolio, then I'd say how exposed are they to what might be coming up in the future? How do they perform in previous? Kraft's an old company; they've been around for a while. So it wasn't Kraft Heinz. Kraft and Heinz merged together. I don't know, 5 years ago, maybe not that long. I don't remember. But how did Kraft perform during the last time there was a recession? Not COVID, but like 2008 or something. Yeah, or even the 90s. Early 90s there was a recession, and then early 2000s there was one too. Any of that, how did they perform? If you get any further older than the 90s, it's old news. It's not really relevant. Okay, so that might be some of the next stuff that's coming up too that we have to think about is, so I have MarketWatch has an economic calendar. Bloomberg has it too, but you can access the MarketWatch thing from home. So the MarketWatch economic calendar is like what's all the news that's coming up. And next week, because we're already at Friday, so this week, Friday, University of Michigan has their consumer sentiment. But this next coming up week, home builders and building permits. So what's the housing industry going to look like? I'm betting it's going to go down, right? If interest rates are going up, less people are going to buy houses. Here in Chico, I had breakfast this morning with a realtor in town, and he's saying a lot of places are getting offers lower than asking, and a lot of places just aren't getting offers at all. Housing prices are coming down a lot. People aren't like trying to get qualified for mortgages right now. So MarketWatch website, yeah, I just Googled MarketWatch economic calendar and it was like the first link. Bloomberg is only available in this computer lab. So this is the Bloomberg lab. So to access this software, you have to be on these computers. Yeah. But when you go, like you just come in here and double click and you can log on and access a lot of this. This lab's open, yeah. You can come in anytime. I think has anyone tried to come in the middle of the night ever? Like recently? No, okay. Yeah. Oh yeah. When no one's in here, these are like motion sensor lights. So if no one's been in here for like 20 minutes, everything just shuts off. Yeah. Yeah. The door has a light like thing on the outside. If it's green, you can open it. If it's red, that means it's locked. But if it's red, it's probably because it's like 3 a.m. or something. You know. When I was a college student, I was like on campus. I was in the library like in the middle of the night a lot, you know, doing homework and stuff. But I'm not usually here at night anymore. This is just, I don't know, the Federal Reserve is. Okay, so this let's do this real quick. So you can do in-depth analysis. Yeah, let's do that. So if you run so on Bloomberg, you can run any function you want. You can type stuff in and there's functions. So XLTP is the Excel like the program, Microsoft Excel template library. And so that's what I pulled up to get this, and it's loading. If it's been a while, it takes a long time to load stuff on these computers, but if you're using it frequently, it's faster. On the Excel, on Bloomberg, pretty much anything. It's the highest end of financial tech. We pay a lot of money. It's normally to rent one of these computers for like a regular person, it's like $2,500 a month. Yeah, so we have like a 2-year contract to be able to have these for a while. So okay, so this is it. Just opens the default one. So what we're looking at, Kraft Heinz, their KHC and then US, and I don't think I have to actually hit equity. I think I just and it'll automatically update about a bunch of stuff. Okay, so good. So that looked right. So it says Kraft Heinz, so I know I'm on the right company. It's in dollars. So geographic segment. So 75% of their business is in the United States. That's super relevant for if we're looking at other companies who might be operating a bunch in other countries who are having their own issues, right? A company that's mostly exposed to Ukraine, not going to have the same thing as a company that's mostly exposed to the United States, right? Really different. So, and then their business segment. So this is kind of interesting too, because 29% of their business is from condiments, which, okay. And then cheese and dairy. So those subgroups might have their own unique needs, right? For some companies, the subgroups might be not as like similar, right? Cheese and dairy and condiments are, I mean, they're food products, right? So we kind of know like, okay, they're somewhat similar to each other. Half the companies that. But for other types of businesses, I think we looked at, was it Dow Chemical last time, and they had like PVC plastics, but then they had like chemical like products and stuff. And so they're like different kinds of industries. And so sometimes you have a business that's a conglomerate of unrelated things. But if I look down this list, condiments, cheese, ambient meat, I don't know what ambient meat is. Frozen meatballs is big enough. So meatballs is big enough to be its own segment. That's interesting. Other meats. So meatballs is one, and then meat and seafood and ambient meats are 2 others. It's just interesting. And refreshment beverages. So I would have just like put a bunch of these together and said meats is like 30% of the business, but whatever. Okay, so then we say, okay, well, what's the finances then for the company? So price to equity ratio. How much am I paying for price? Yeah, PE ratio. how much am I paying to get the earnings, right, of the company? Price to earnings. I said equity, didn't I? Price to earnings ratio. And then what has it changed over time? So right now, well, that's projection. Right now, there we go, is for the end of 2022, we're thinking 12.9 times. But if we look forward a little bit, we're going down. Now, are we going down because the price is going down, or are we going down because the earnings is going up, right? So this is a ratio of how much do I pay for earnings, and if the price stays the same while their earnings increase, that's I mean, not really a good thing, but you expect to make profit that way. If the price goes down while earnings stay the same, my PE ratio will be going down, and that's not really what I want, right? They're borrowing, so their credit rating is BBB minus, which isn't the best. So when interest rates go up, they're going to be more affected, right? Because people are going to want safer investment or safer loans, right? If you're going to borrow money. So a AAA credit rating would be better. We can look at some of their margins, but I don't think that's going to have a big effect on interest rate changes. And then current ratio for sure, because their debt is they're going to have interest on their debt. So their current ratio, quick ratio, not so much. That's literally cash. How much they earn versus their interest expense, that's important. Okay, so we're moving forward in time as we go to the right. So this is the most recent. How much do they make before they have to pay their interest and taxes compared to what their interest expense is? 1.7 times. So they make more, like 1.7 times their interest expense, which by itself is, we might look at that and say, okay, maybe that's good, maybe that's not. Who's Kraft's biggest competitor? Well, there's a button here for peers. General Mills. Okay, Hershey, Tyson, Kellogg's. I would think, I don't know. I think Tyson makes more sense than General Mills, but maybe not. I don't know. So let's go look at Tyson now. So TSN. We go over here and we say, okay, so for Kraft, their amount of earnings compared to interest is 1.7. For Tyson, TSN, it only takes a long time to load the first time. Once I run Kraft again, it'll go right away. For them, 10.3. Okay, so that's way better. So Tyson has way more earnings compared to their debt, right? So if we go look at their financials, go to their balance sheet, we go to just total liabilities. All right, let's just do this. I'll just pull up a new tab and we'll just go TSN, US equity, WAC. Their long-term debt is about 20% versus Kraft's long-term debt is 29%. Kraft has, financed more by long-term debt, 69% on market cap, 77. So they're a little bit more, equity for Tyson. So, but that 10.3 on Tyson means that they make a lot more money compared to what they pay in interest. So either they pay less in interest, and so I might want to say, well, what's the DDIS? Tyson. So the debt distribution for Tyson. So 5.1 on that, the shorter term. 3.5 on the shorter term versus Kraft, who's got. Let's just look at the distribution a little bit. There's for Tyson, they have kind of a barbell shape, right? Like a lot front loaded and a lot back loaded, and then just kind of a gap in the middle. And then these floating rate debt, that means it's like a variable rate loan, but they're coming due in the next 2 years. So then that'll be gone and everything's fixed rate after that. Versus Kraft, I think Kraft seems to have gotten more like regular financing with debt, whereas Tyson almost does it like on an as needed basis. It's just what I see. I don't know. Does anybody else disagree? You don't have to agree with me. You can tell me I'm wrong. I don't care. But I don't know. Maybe my interpretation of that might be that Tyson might not be as dependent on debt, whereas Kraft like regularly needs it. Variable rate. It's floating interest rate versus fixed interest rate. Yeah. And for whatever, so that's Craft. That's oh, didn't it say unknown before? Okay, now it just says floating. Oh, that's true, I did. But I unclicked it. Maybe it just had to load. Maybe it was just like it didn't know what it was, and then it finished loading and said, "Oh yeah, floating." I don't know. That's weird. I would think if I was looking at this, I would think the floating debt was a long-term debt a long time ago, and it became short-term now because they've held it for that long. But we can go see when it was originally offered, and they probably offered it back when interest rates were higher. I was hoping they would open more information about this. It's just not. Data unavailable. Oh, that's annoying. There it goes. So I want to see the original offering. 2021? That's not that old. Yeah, it was announced in 2021. Oh, well. Okay. You want to buy some of their debt? It won't let us. We don't have an account set up with them. Okay. So I thought maybe they had issued it back in like the earlier 2000s or something, but I guess not. But if that's going to go away, so that's floating rate debt, and their floating rate debt. So for Craft, their floating rate debt isn't due till 2027. So an increase in interest rates right now will affect this, which has 4 more years to go, right? Or 3. Or sorry, 5, whatever. What year are we? 2022, 2027? 5 years. 5 more years to go. Versus Tyson, whose variable rates are going to be due quick, right? So so if interest rates go up right now, the variable rates will also, the cost of that will increase, but it'll be over fast. Whereas Craft is like, yeah, that'll increase, and there's a lot of it, and it's not going to be over for a bunch of years. I would not want a company with a ton of floating rate way out, right? That'd probably be bad. There's another thing we can use on the Excel library. Financial analysis. I want a DCF. So I can go to, so let's go list view. And then these are all of the Excel files that you can download with all kinds of different things built in. And I starred the ones that I like, I think, or maybe they came starred that way. Pretty sure I remember starring these. Comparable valuation, yeah, let's do that. We'll compare Craft and Tyson. Where do I change it? This one? Enter ticker there. Yep. So we want KHC US equity. And then let's see. Yep, good. So then it'll automatically pull in its peers. So we gotta wait for it to load everybody, so that we can quickly look at. This is like this slide right here just looks to be trading information, right? 52-week high and low. I don't care so much about that right now. Total debt's down there, market cap's down there, preferred equity, that's all down there. Okay. So total debt, that's fine. I would rather see it as a percentage of their total value, right? So just the debt numbers don't really matter to me because the size of the company makes a difference. Let's go. EBITDA growth, total debt. There we go. So how much debt do they have per their earnings, right? This is EBITDA is earnings before interest, taxes, depreciation, amortization. And so that's like before they have to pay their like cost of doing business or their like cost of financing, I guess. Who's biggest on here? Looks like that one. Those are the most, so that would be MKC and CAG, whoever the heck those people are. But those would be the most, they have the most debt compared to their earnings. So the lowest looks like 1.6 there, and that looks like it. Tyson, okay, cool. So Tyson seems to have the best earnings compared to its debt, right? So, and then Hershey has a better credit rating. Tyson's not bad. That's one. So triple B plus is one step below A, and then it'd be double A and then triple A. Triple B minus is pretty bad for Craft. I don't know, man. I think I'm kind of convincing myself that Tyson might be better than Kraft. What do you think? Thinking the same thing. But that doesn't mean we want to own Tyson. But it means if I had to choose between Tyson and Kraft, I might. One thing you could do, I don't know. So the other problem is like Kraft and Tyson aren't exact copies of each other, right? It's not like a Walmart, Target, or Home Depot, Lowe's. Oh, those aren't exact copies, but they're like really close to similar, right? Whereas Kraft and Tyson are different. Like they're both in the same sector and they see each other as peers, but Tyson sells chicken and Kraft sells ketchup, right? So they're not exactly the same. But you could do like pairs trading where you say, I'm going to buy one and short the other. We can't because we're the student managed funds. We can't short anybody. But one thing that could be done is where you buy one and short the other. So we're not necessarily worried. Let's say the whole industry tanks, right? All of food, condiment stuff tanks. Well, I'm short one of those stocks, so I'm going to make money, right? I'm long the other ones, I'm going to lose money there. So I'm essentially even, right? If the whole industry goes up, well, I'm short one, I'm going to lose there, but I'm long the other, so I'm going to be even. So no matter what happens, if they're really close to similar to each other, no matter what happens, I'm going to stay flat compared to the industry. I'm neutral the industry, but I'm saying I'm long one stock, short the other, because I think this company will outperform the other one. That's the thing there. So if you said, I think Target is just a better company than Walmart, but I'm not willing to take a bet on retail sales, I just think Target is a better performer than Walmart in general. And I long Target, short Walmart. Retail sales tanks, I don't care. Retail sales spikes, I still don't care. I'm neutral retail sales. I'm long Target's business model compared to Walmart's business model. And then I say, well, what's the difference between the two companies? Walmart serves a higher end clientele, kind of, and so, sorry, Target does. Target serves a higher end clientele than Walmart does. So maybe I'm saying I think there's going to be more spending from the kinds of people who shop at Target compared to the kinds of people who shop at Walmart. There'll be more spending on chicken than ketchup. I think maybe, yeah. I would say if like it's a really bad recession, you almost say, well, I can't afford condiments, but I like, or maybe I don't know, broke people just like, well, like yeah, that's right. So I don't know. That's tough. That's tough. I think they'll probably both do better. They'll do better in a recession than they would in like a booming economy, right? Be like high end restaurants would do better if the economy's doing well, right? You would say, I'm not going to buy frozen chicken. I'm going to go out to eat every day of the week. That's tough. That's over here. It's supposed to be not supposed to be easy. What thoughts do people have? Mm-hmm. Mm-hmm. Yeah. Okay. So just repeating for the sake of the Zoom. So looking at the different debt levels, it's a little bit. Did you say alarming? Is that the word you used? Yeah. Okay. It's alarming that they have this the floating rate debt due soon. So it says 4,000 million. So they have 4 billion in variable rate loans due in 2027. And I tried to see what the interest rate is on that. So let's go. I could go table. That's it. That's the 4 million debt. I open it. 3.99 right now. Senior unsecured loan. Coupon is the payment that bonds make. Yeah, so you get a coupon payment every like 6 months, maybe. It depends on the debt. Some of them are quarterly, some of them are annually, some of them are. There might be some that are monthly. I'm not sure, but yeah, coupon is the payment that you receive from a debt. So they refinanced, I guess, for corporate reasons, in just like 2 months ago. Okay, so they just did that. Really, on a variable rate when rates are low. That's weird. I think that's not a very good idea, but they did. So what are we? So let's say, what does send tranche mean? Oh, email it to somebody. I don't need to email it to anybody. Okay, so let's go look. Can I copy this? I have to go. I'm gonna try something else. Hold on real quick. So let's go over here and go. this is the right website for that. Yeah, and then so 50075 EAB0. 50075 EAB0. Done. Is that an O at the end? Maybe that's a letter O and not a 0. Yeah. All right, then we'll just look up the craft. Yeah, and then we go. We want the one due. So maturity is in 2027. No, do this real quick. I gotta look through all of them. There we go, 2027. Right there. Original offering is 1.3 billion, so that might not be the same one. Another 2027. That's the one I just clicked on. There's another 2027. Okay, so we'll try that one. BRK 498. No, they want BL or BBD. Well, shoot, I don't know. I was gonna see if I could get more detail on it, but I don't know that these are the same ones. No, that's a fixed rate. So it's okay. I was just gonna try to get more detail, but that might be something you want to look at too. Is when we're gonna. So the idea here is we're gonna take some stock ideas, pitch them to the group, and say, okay, let's actually buy some stuff, right? So I think for as in terms of the structure of our portfolio, because it's 12:45 right now, so we'll like start trying to come together for some stuff here. In terms of structuring our portfolio, our goal is to beat the S&P 500. And so we kind of want to match any money that we're not investing should be matching the S&P 500. So we might buy like an ETF or something that just matches the S&P. And then any specific stocks that we buy, we want to hopefully beat the S&P in terms of risk reward. Right? So if we look at what's the riskiness of, like, let's say maybe we're going to look at Tyson now, right? I think we kind of all said, okay, Tyson probably beats crap. So okay, so we're looking at Tyson. What's the riskiness of Tyson? More than the S&P because it's a single stock versus the whole market. So, but do we expect Tyson to get a better return? So how do we figure out what do we think Tyson's return is going to be? That's the question here. So let's go back to Excel templates. Let's go to the library. Excel TP DCF. I want a DCF model. Or it's XDCF, I think. Yeah. Go ahead. No. Yeah, not every company is gonna. So how do you know when to invest in a stock if you don't know what the dividend is or when it's gonna be or anything? Yeah, yeah. So we don't need to care about the dividend so much. There's lots of companies that don't pay dividends, so we might want capital gains growth, right? And the type of fund that we are isn't an income-based fund, so we don't need our focus shouldn't really be on dividend. We may happen to buy a stock that pays dividends. We may receive a dividend, and that's fine, but that's kind of just coincidental mostly. So we want capital gain growth, and so this is what I'm pulling up right here is the XDCF. So this is discounted cash flow. So let's use Tyson now. TSN US. What be the change? Yeah. Capital gains would be the stock price goes up and we sell it for a profit. Capital gain. Yep. So this DCF model, discounted cash flow model, makes some assumptions that we can alter. And so it's loading, it's taking forever. But it'll build a model of if the world were to do this, Tyson would respond in this way. And then we want to say, okay, well, if that's the case, what happens? Is it done already? Didn't fill in any of these numbers. No good. Oh, it says invalid security. TSN US. I won't put equity. Maybe it just doesn't know what to do with the word equity. Yeah, there it goes. Now it says Tyson Foods. Now the numbers are showing up. So this is building a discounted cash flow model, and it's saying, what if these things happened? Then what would our stock be worth? And so then we can say, well, what do we think the likelihood of those things happening is? Maybe we change some of the assumptions and now then build a model for what do we think the stock will end up being worth? At which point we say what's it currently worth versus what we think it should be worth. Maybe there's a gap there, 12% difference. We say we could make 12% if we buy it. Whatever you want, really. So we'll walk through it real quick. So it starts by saying, well, here's some of like the incomes and stuff. And so free cash flow is one of the big things that we worry about for a company. How much money is left over after they pay all their bills, basically. EBITDA is like how much do we make before we pay all our bills, and revenue is just sales, right? So, okay, cool. So money that the company's making. This is a table that these are both tables that use data from down here, like way down, in order to populate this table. But what it's saying is, so this is EBITDA multiple. So how many more times the earnings before interest, taxes, depreciation is it worth versus what the discount rate is? What's their cost of fundraising? So if their cost of fundraising were to go up, which we think it probably will, then what happens is they end up going down in price, right? So down here, same idea. It looks like there's no label here. I don't know what they were supposed to be labeling right here. Is this like default versus our assumptions? I think. Oh, this is per share, and this is the whole, or this is the whole company, and this is per share or something. Yeah, per share. So this is per share. Sorry, I have to like get used. It's been 6 months since I've looked at this. So this is the per share value, and this is for what? For our investment. If we were to buy it, I guess. I don't know why that. Like, how do you lose 113%? Doesn't make any sense. Estimated upside. So we'll go with this. So we think in this scenario, in the middle, like taking the average, the middle assumption is if their cost of capital is 6.5% and they have a EBITDA multiple of 5.8, then we think their stock price is going to go down by $9.11. I think their current stock price is wrong somewhere. I think that's what it is. I think it's saying the price goes down $9, which is 113% loss. So that's not right. So what is Tyson's current stock price? Oh, on their bond. Their current stock price is $71.99. So this shouldn't be down 113, right? So let's go look for. There it is. Oh, dang it. Yep, hold on. Okay, so that number came from this. Go find it real quick. Shares outstanding, current debt, current preferred interest. Okay. Yeah, I think that I'll have to go look at what like how they built this. But the idea is we can go through these numbers here. So this is essentially their income statement and what it would be for each time period. And so we can say, well, what if we think it's different? So we can say it's going to grow by some percentage, or we can change it by some specific dollar amount, right? And we can do that for each of these. That's for revenue. But then we could do it for their gross profit. Let's say we think their costs are going to increase. But I would go and say, instead of here, I would say, what is their interest expense? Where is interest expense on here? And then operating expenses. Okay. So operating expenses as a percentage of revenue, maybe that's going to change over time. And then because we think interest rates are going to go up, and then how does that affect? This might be not the company we want, right? So overall, we think Tyson is better than Kraft, but overall, we don't want either one because their stock price is going to go down when interest rates go up. How much do they? their actual cost, so their combined cost is 7%. So it costs them 7% to finance the company. Am I on Tyson? Tyson Inc. Yeah. This looks like a different graph than we saw before. Yeah, I don't know what I was just on. So it costs them 6.5% right now. So their equity costs about 5.6. Their debt, well, their equity actually costs them 7.3, but it's 77% of the company. So overall cost 5.6. Their debt costs them 3.7%, which is 20% of the company. So it's 0.8 total cost. And then all combined, it costs them 6.5% to finance the business. So if they make a good amount. So if their cost went up to 7 or 8%, let's say, because the kind of the thought on the market right now is that the Fed's going to raise interest rates by 75 basis points on Wednesday next week. And if that happens, then Tyson isn't a AAA company. So their interest rate's going to increase probably more than that. It could be a full percentage point in cost of debt for them. And so if that's the case, what did I just have before? PDIS. So if that's the case, and we go look at, so if their cost of borrowing is 1% higher, they're going to need to borrow. They're probably going to try not to borrow. They'll either borrow just for the short term or something, or they're probably not going to try to borrow long-term debt, right? So they might not add more on here. They might sell stock instead. I mean, the stock price goes down. They finance that way. What was the difference? 7.3. No, because it's still even with higher interest rates, if their cost of borrowing is less than 7.3%, it's still cheaper to finance through debt instead of equity. And they could afford it because they're not, like, they have most of their financing equity now. They could afford to add more debt borrowing instead of equity borrowing or equity financing. What questions do you have about that? It's pretty complex, right? Not easy. We're gonna spend some time. Like, we're not gonna have every week somebody comes in with a stock pitch that they put together that week, right? Like, we're gonna spend some time putting these things together. If they had to finance their company, right? So if they had, if they had to get money in one way or the other. Currently, their cost of debt, so right here, their debt cost is 3.7% of like, that's how much it costs them on a loan. So on average, and that's average. So the average of all their current debt is 3.7%. Some are higher, some are lower. Debt is 23% of their business. So the overall contribution to the business costs is 0.8%. The 77% of their business is funded through equity, which costs them 7.3%, right? They could. Now, there's a lot of factors that go into that. So the finance division of people at Tyson Foods might say, well, yeah, we can have more debt, but in order for us to remain competitive compared to our competitors, they don't have as much debt. And so maybe we shouldn't finance their debt because, it's going to affect us this way or that way. I don't know the internals of Tyson, but so they might have some, internal discussion that says, yes, we can afford it, but no, we won't do it. Right. Yeah, but as of right now, let's say their average cost of debt went from 3.7 to 4.7, then their total cost of capital might change too. Let's calculate that real quick. Let's pretend they retire. What if they just, so next year when they retire this amount of debt, they just refinance it with the new debt or something, right? So then we say they keep the same amount of total. It's called capital structure, 77% equity, 23% debt. They keep that same 77.23. And if that's the case, then we have 0.22 times, instead of 3.7%, 4.7%. So I type 0.047, right? So 1% instead of 0.8. So I say that plus, and then we leave equity the same. Let's say equity stays the same, 0.056. And so now we're at 6.6. That's actually not a huge difference. So maybe it won't affect them that drastically if interest rates increase, right? 6.6% cost of financing overall for the whole company instead of 6.5% cost of financing for the whole company. Well, if that's the case, we go back to our DCF model. We go all the way to the top. We go find their cost of capital somewhere, their WACC, and we say, okay, well, 6.6 instead of 6.5. So we're here. We're in this row. or we're really between these two rows, but and we say, okay, well, they're doing worse off. So as a company, they'll do worse off, but maybe not drastically, but I still don't want to deal with it. Right. But now I didn't go through and change every assumption in this model. I got to go, like, if I was going to actually use this model to make a real decision, I should go through each point and say, okay, well, what assumptions are being made? Because I literally opened a default file, right? So there's probably a bunch of assumptions built in here that I disagree with. This is pretty good. An hour. Yeah. But I mean, so we're at 1. So I'm going to say that's probably the end of our meeting, but I'm down to hang out and talk. And we can look at whatever. But I think, does anybody have any questions? Okay. For the purpose of the Zoom, then maybe we just end it. Zach, are you good? I know you haven't said anything or anything.
Yeah, just one quick question. Is there anything we need to have prepared for next week? I'm about to run back into the office myself.
No, nothing that has to be prepared, but let's like keep coming back and saying, like, let's start modeling and stuff. And so look up some stuff for what the economy is doing. So by the time we meet again, the Fed will have announced interest rates. And so maybe we want to start we'll put together a plan for what we think the economy is going to be doing over the next 6 months. Then we'll start saying, okay, now what stocks should we look at?
Okay, and again, we're not just limited to regular companies or stocks. We can look at like ETFs and conglomerative things like that, even inverse funds.
We can do ETFs, yeah. I'd rather not do mutual funds, but ETFs, yes.
Okay.
Yeah, only because we'd have to pay a fee to have a mutual fund.
Yeah, most of them. Okay.
Yep, good plan. Okay, I'm gonna hit stop recording.
I'll see you on Tuesday. Thank you.
All right, Zach. See ya.